Right.
All right, well, hi out there, FFG land. Kelly Goodwin with my regional assistant Jeffrey Hamill and Joshua Hess are here with me. We're going to talk to you today about a really important tool that you should consider using in your practice. It's called a 72T or a 72Q withdrawal. That is a section of tax code that you can look up online and read about this. I'm going to give you the salient points about this and how I like to use it in my practice. Hopefully you can go out there and use this tool as well to increase your income and to help your clients, again, avoid the biggest trap that we know that there is, which is taxes while in retirement. Now, we know that all the monies that we're putting into qualified plans are going in, for the most part, pre-tax, growing tax deferred. That sounds great at first, but then we have this pressure cooker is the way I like to describe it to my clients. It's very visual. Pressure cooker. We keep adding money into these contracts. It's growing, we hope, but at the same time, it's building up this huge amount of pressure. And when we go into retirement and we take that lid off, boom, we get hit with a huge tax bill, taxable from $1. Now, the thing is that as we know and expect, inflation is going to cause us to have to pull more money out in retirement. More than likely, tax rates will be higher at that time, so that's the problem. So how do we use the 72T? Well, let's say that you have been working with a client and you have already sold an index strategy life savings plan through Aviva, obviously. All right? And so they agree that money coming out tax-free makes more sense than money coming out taxable. So in your fact finding, we actually know that our client has got maybe a small IRA, an old 401k that they haven't transferred to a new plan yet, self-directed IRA. And you approach them like this and you say, you know what, here's the thing. If we leave that money there, and let's say that we do put it into an index strategy annuity, again with Aviva, and let's just use, for round numbers, let's say $50,000, and we transfer it from that self-directed IRA, that old 401k, could be a 403b, 457 plan, right? All of these different things. We transfer this money, you do a rollover so that there are no taxes right now. Of course, they get a bonus, 5-6%, whatever the contract is at that time. They start out with more money and they have the guarantees. So over here we have our index strategy life savings plan, okay, and they're funding this, let's say, with income. And now we see this $50,000 and we ask them the question, Mr. and Mrs. Client, if there was a way that you could transfer money from a future, basically, tax bomb and pay the taxes that are due on it today to the extent that you don't have exemptions, credits, and deductions, but no penalties, would you like to be able to do that so that you could then pull the money out tax-free every year in retirement at that point? Would that make sense? Now, most people will agree with us that tax rates, again, in the future will probably be higher. If our exemptions, credits, and deductions are minimized or done away with, net effectively the tax rates are higher, okay? And again, if inflation is going up faster or pretty quick, and depending upon where you're reading, retirement costs can be going up 6, 8, 10, 12% per year, depending upon, again, your sources. So most of the time they'll agree with you, yes, I would like to pay the tax bill that I owe now. I know what I'm going to have to pay today. I don't know what I'm going to have to pay in the future. And it could be much, much more. So at this point you'd say, well, what we can do is something called a 72T or 72Q. Now, a Q is used for a non-qualified annuity. If they're non-qualified monies, that's the section of tax code that we use. 72T is for all the qualified. So, in general, depending upon the person's age, we're going to be able to pull somewhere between 3 and 5% of whatever that amount is per year. Now the calculation is available online. There's 72t.net, bankrate.com has it. You can also call Aviva and go to the Advanced Designs Department. They will run those calculations for you. But here's the thing. Understand that when you're setting up this program, you're going to let the client know that from the age that they start for a minimum of 5 years, or age 59 and a half, or whatever their qualified plan retirement age is, they must pull a substantially equal series of payments for 5 years or age 59 and a half, whichever is longer. If they don't do that, what happens is the IRS will unwrap this 72T plan. They will totally kill it. All of that money will be taxable in that year based upon their income tax rates, and penalties will apply as well. Okay? So this is something where when you're talking with your client, you need to be crystal clear. They need to understand. You should recommend to them that they confirm this information with their tax expert so that they're totally comfortable. Now, the thing is, I've used this a ton in my own practice. And the reason why it's so awesome from our point of view, now stepping back and thinking about it from commissions, and also from the point of view of having payments ongoing into the policies, is that wouldn't it be nice to know that you didn't have to worry about your policy being funded with the client's income, or at least not 100% funded just from their income. Stuff happens, right? We teach people to have an emergency reserve fund, but they don't do it, okay? So if we can know that somewhere between 3 and 5% of that $50,000, okay, could be $2,500 a year, could be $15,000. I've had 72Ts triggered on $300,000, $400,000, $500,000 accounts. And that money goes in here every year like clockwork. No lapses. Okay, no underfunded. And again, this is just making it easy for the client. People like things that are easy. Okay, so again, Mr. and Mrs. Client, if I could show you a way so that we could take some of the tax bomb that you've already created, and say that with a smile, and we could minimize the effects going forward in time. If I could help you pay your tax bill now, the amount that we know, that we actually have some control over. Maybe they could defer income if they're business owners into next year. Or maybe, again, they have a home that if they talk with their tax advisor with your help, they say, hey, it makes sense to increase the size of my mortgage so that I have more of a tax deduction. Or maybe they start that small business to give them those exemptions, credits, and deductions. The point is that we can control our tax brackets to a fairly good extent now, whereas in the future, again, if we don't help them do this, house is paid, kids are gone, they don't have a business, what happens? The only way to control their top marginal tax bracket is by not spending money. So 72T can be an awesome tool whereby we can minimize the lifetime tax bill, make sure that the index strategy life savings plan that we put in force stays in force, and the client has guaranteed income for life. So that being said, is there anything, guys, that I missed?
I've got a question. So just to be clear, using this type of tool, you can either fund completely or partially. Okay, so let's say that you showed them the life and they liked it, but they couldn't just make the premium payment as they should have to help them benefit the most.
Out of their ongoing income.
Exactly, out of the pocket.
And yet maybe they have an old 401k or an old IRA or an annuity or something like that.
Okay.
Absolutely, absolutely. So you can use this as the sole source of funding if you wish.
Fantastic.
And understand that when Aviva runs the 72T calculations for you, they're always going to be within the free withdrawal corridors that are set up in the plan. Okay, that's very important to understand. Don't worry about that. So as we know, there's a 5% free withdrawal corridor in the first year, 10% in the second for the next 9 years. This 72T will fall within those parameters, so you don't have to worry about the client getting hit with any surrender charges or penalties or things like that.
Okay, gotcha. So effectively, again, just so I'm clear, if you were to roll monies into one of our annuities and 72T it to fund a life, effectively, you'd be paid twice on one piece of money without impacting the client in a negative fashion.
Absolutely, that's another really good way to think about this, which is not only are you helping the client in a very substantive way, but we're looking at, as an example, let's say that we had a $100,000 death benefit on this policy based upon the income and taking a look at their budget. Maybe that's $200 a month, as an example. Let's say the target on that was 24. Well, we see that there's this piece of business over here, and yeah, it makes sense they want to do an index strategy annuity, right? That's just a pickup sale because they understand the power of locking in their gains and locking out their losses. But you need to take the next step. The next step is saying, hey, if it makes sense to have more tax-free income in retirement, pay our tax bill now, hey, we got to talk about a 72T. Now, you can kind of ballpark this by going online. Let's say the 72T is going to give you, again, let's just say 5%, depends upon the age, $2,500 a month. I'm sorry, a year. $2,500 a year. That's another $200 and change per month. Now you can legitimately increase the size of the death benefit. You're putting more money into that, okay? And you could potentially increase the commission over there as well, if it makes sense. Again, you always have to do the best thing for the client. You don't want to sell them too big, right, of a wrapper. It's got to be something that works. But this is potentially a way to increase your income as well as doing a really good job for the client.
Fantastic. Fantastic. I like it.
I also have a question, Kelly. When the client takes the 72T distribution, does a check have to get sent to the client and that left up to the client to send that into the life insurance policy, or can we eliminate the temptation of the client to do something other than what they should and have the money go straight from the annuity into the life, out of sight, out of mind?
Actually, we can do that. Okay, Aviva has, if it's an Aviva to Aviva product, we can do that. So that does remove temptation. You're absolutely right. There's many a slip between the cup and the lip, as they say. So let's remove that little temptation for them. So the answer is yes. We can actually get that set up through Aviva.
All right.
All right. So that being said, I hope that this little teaching session has given you some additional information, things to think about. A 72Q, again, section of the tax code, look it up, makes a ton of sense. If you have any questions, you can always hit our office, hit me with any questions that you have, ffgkelly@gmail.com, or you can send an email to ffg_sacramento@att.net. And we're always there for you out there in FFG land. Keep up the great work. We'll see you at the top. Thanks so much. Have a great day.